What a wild ride we have for the stock market this week. SPY finally closed above its range that it's been in for the past 6 weeks, just above $420. And QQQ ended up Friday alone up by 2.5%, almost closing at $350. But every other stock that's not a big tech name, if you're not mentioning artificial intelligence, you're getting left in the dust. It's a very eventful week, so let's talk about what happened. On Monday, we had a ton of Fed members, and Fed Bullard started us off this week.
So far, you've got fairly robust growth for the U.S. economy in 2023, and you've got inflation that has not come down fast enough. Now you've got markets ratcheting up their expectations for inflation for the whole year. I saw a chart on Bloomberg today. Now markets are thinking that inflation for the whole year will be over 4%. They used to be have a 3 handle on that. They moved it up over 4%. So I think the 5 1/8 idea was based on a slower growing economy than the one we're actually seeing. And it's based on inflation coming down faster than what we're actually seeing. So for that reason, I think we're going to have to grind higher with the policy rate in order to put enough downward pressure on inflation to return inflation to target in a timely manner. So I'm thinking, 2 more moves this year. Now, exactly where those would be this year, I don't know, but I've often advocated sooner rather than later. You want to get the downward pressure on inflation while you can. And also, you want to fight inflation while the labor market's really strong. You've got an unemployment rate here, a national unemployment rate of 3.4%, a 50-year low. Most of us have never seen that in our business careers. You've got job openings still 40% higher than they were in 2019 before the pandemic. It seems like quite a bit of structural change going on in the labor market. It's still hard to get workers. So as long as the labor market is so good, it's a great time to fight inflation and get it back to target. Get this problem behind us and not replay the 1970s.
So Fed Bullard is calling for 2 more rate hikes by the end of the year. Granted, Fed Bullard is the most hawkish Fed member, and he's not a voting member, so his word doesn't carry as much weight to it as somebody like Fed Kashkari, who's also a major hawk. But we didn't get much confirmation from any of the other Fed members on Monday, with Fed Bostic saying that he's comfortable waiting in order to make a decision for the June meeting, whether they're going to pause or do 25 basis points. And Fed Dollar was basically the same.
I really think we all have to be Bayesian. We have to have a prior. In case there's econometricians in the audience, we have to have a prior about what we think, and then we have to constantly update our prior as we get more information. So I'm going to hold myself to that standard. My prior is that the credit tightening that I'm seeing in the data and that I'm hearing from my contacts in the banking sector could be worth as much as a couple of rate hikes. So if you think that's worth a couple of rate hikes, then I want to be mindful of that and imagine that I need to learn about, is that really true? Is it worth less? I mean, there's estimates out there that it's not worth anything at all the way up to 200 basis points. So that's a pretty broad range. My own personal starting point, though, is 1 or 2 rate hikes and continuing to watch to see if that's really true. Do I see the economy slowing more than I would anticipate given just the funds rate increases we have made? And if I do, then will that be sufficient to bring demand back in line with supply and get that relief on inflation that we need to see to restore price stability in a timely way?
So essentially what Fed Dollar is saying here is that we are going to be data dependent, and if there's any banks that end up collapsing between now and the June meeting, then we're probably going to pause. And if there's no bank collapses between now and the June meeting, then probably we're going to end up raising. And then Fed Dollar also commented on the unemployment rate, saying that it is a historical anomaly in order to get inflation down from what was about 8% to 2% without having unemployment going up. And Fed Dollar expects the unemployment rate to rise from 3.4 as of the latest reading to 4.5% in their highest projection. So they're expecting a 1.1% increase in the unemployment rate while they get inflation down from about 4-5% as of right now down to 2% within the next couple of years. So that's all the Fed speak from Monday. And then on Tuesday, we had PMI with manufacturing PMI coming in worse than expected. Surprise, surprise. Every single month this comes in worse than expected. It came in at 48.5 versus 50 expected, down from 50.2 in April. So this means that manufacturing is continuing to see a slump. That means that we're not producing as many goods. And this can either lead to a recession or more inflation to come, because if there's the same amount of demand and there's less goods being produced, then people are paying more for less goods. Or if people are buying less goods, that means that we're going into a recession. So manufacturing PMI coming in worse month after month after month is not a good sign. And then the global composite PMI actually came in better than expected, thanks to services PMI coming in really, really hot at 55.1 versus 52.6 expected, up from 53.6 as of May. And services is a very sticky place for inflation just because the prices of services are generally lower and more affordable to the general public versus high-end goods like vehicles, houses, and things like that. So services PMI is still sticky, and that means that inflation in services is still sticky, which ended up in the global composite PMI coming in hotter than expected at 54.5 versus 50 expected, up from 53.4 as of the last reading. On Wednesday, we had the FOMC minutes coming out, and the highlights from this is that the Federal Reserve generally agreed last month that the need for further rate increases is less certain, so they're not sure if they're going to continue to raise or not, with several participants noting if the economy continues to evolve along the lines that they're currently projecting, then further policy firming may not be necessary. But almost all of the Fed officials say that inflation is still sticky, and almost all of the Fed officials were saying that the risk in banks is very high as of right now. So we still have inflation, we still have crashing banks, so we're uncertain on whether or not we're going to continue to raise at the June meeting. On Thursday, we had continuing jobless claims coming in a little bit better than expected at only 1.794 million people unemployed versus 1.8 million expected, and this is down from 1.799 million as of last week. And then we had GDP coming in a little bit better than expected at 1.3% versus 1.1% expected. And this is down from 2.6% as of a quarter ago. And then the initial jobless claims, or the number of people that applied for unemployment this week, came in at 229,000 versus 250,000 expected. And this is up from 225,000 as of last week. And then Thursday, we had the big earnings of the week that everybody was expecting, with NVIDIA reporting and going up by 25% overnight. The highlights from this report was their revenue that they're expecting for the second quarter of this year, where they're expecting $11 billion in revenue versus only making $7.19 billion this quarter. So they're expecting a 50% increase in their revenue quarter over a quarter. Whether they're actually able to achieve this or not, that's going to be up to what we see at the next quarter results. But they did do a share offering, or filed for a share offering on Friday, the very next day after they reported this. So a little bit shady, yes, but their stock is up by 25%, so might as well take advantage of that. Also on Thursday, you had the Fed balance sheet coming in lower than it was the week before, currently at $8.436 trillion, almost down to where we were before at $8.33 trillion on the Fed balance sheet before the Silicon Valley Bank collapse. So we're almost erasing all the liquidity that we put into the markets over the last couple of months. And then on Friday, we had a bunch of data coming out, with core durable goods coming in worse than expected, down 0.2% versus 0.0% expected, 0.3% for the month of March. Core PCE came in higher than expected at 4.7% versus 4.6% expected, up from 4.6% for March. The month-over-month reading ended up coming in at 0.4% versus 0.3% expected, up from 0.3% for March. The durable goods order came in better than expected at 1.1% month-over-month for the month of April versus negative 1% expected, down from 3.3% for the month of March. And then regular PCE came in at 4.4% versus 3.9% expected, up from 4.2% for March. And then the month-over-month reading came in at 0.4% versus 0.4% expected, up from 0.1% for the month of March. Personal income came in at expectations, 0.4% versus 0.4%, up from 0.3% in March. Personal spending ended up increasing, going to 0.8% for the month of April versus 0.4% expected, up from 0.1% for March. Retail inventories ended up decreasing by 0.1% versus positive 0.1% for March. Wholesale inventories ended up dropping down 0.2% versus 0% expected and 0% last month. And then the Michigan Economic Report came in a little bit better than expected, with the 5-year inflation expectations dropping to 3.1% versus 3.2% expected, up from 3% for the month of April. And then the consumer expectations ended up dropping a little bit, 55.4 versus 53.4 expected, up from 60.5 for the month of April. The consumer sentiment was worse than last month, 59.2 versus 57.9 expected, down from 63.5 for April. Current conditions ended up dropping to 64.9 versus 64.5 expected, 68.2 as of April. And finally, the inflation expectations ended up dropping from last month to 4.2% for the 1-year inflation expectations versus 4.5% expected, down from 4.6% for April. And at the end of the week, the odds for another 25 basis points ended up increasing to 64% from 52% on Thursday, and up from 17% as of last Friday. So now the ball is in the 25 basis camp, but there's a lot of data to come out between now and the June meeting, so we'll have to see how this evolves. And as of Friday, we didn't have a deal that was reached for the debt limit, but the X-date did get extended from June 1st to June 5th, and on Saturday, Biden and McCarthy finally came into making a deal. But this is going to be determined by the House, that's controlled by Republicans, on Wednesday. They're going to be voting on Wednesday, so if we actually get this passed, then I would expect a decent rally on Wednesday. But if we don't get it passed on Wednesday, if the House ends up rejecting this and making McCarthy come up with a new deal, then we could be in some trouble. So that's what happened this week. And then for next week on Monday, it's going to be Memorial Day. Happy 3-day weekend to y'all. Tuesday, you're going to have the CB Consumer Confidence coming out at 10 a.m., where we're expecting 99 versus 101.3 as of last month. Fed Bowman is scheduled to speak at 8:50 a.m. on Wednesday. And then the JOLTS job openings is coming out at 10 a.m., where we're expecting 9.775 million jobs available versus 9.59 million as of last month. And then Fed Harker is going to speak at 12:30, Fed Jefferson at 1:30. On Thursday, you're going to have ADP non-farm employment change at 8:30 in the morning, where we're expecting 296,000 jobs added for this month. Jobless claims is coming out at 8:30 in the morning, where last week we saw 229,000 initial jobless claims and 1.794 million as of last week. And then the ISM manufacturing PMI is coming out at 10 a.m., where we're expecting to see 47 versus 47.1 as of last month. And then Fed Harker is scheduled to speak at 1 p.m. On Friday, you're going to have average hourly earnings coming out at 8:30 in the morning, where we're expecting this to increase by 0.4% month over month versus 0.5% as of last month, and 4.4% increase year over year as of last month. The non-farm payrolls will be coming out at 8:30 in the morning, where we're expected to see 180,000 jobs added versus 253,000 as of last month. And then the unemployment rate is coming out at 8:30 in the morning, where we're expected to see 3.5% versus 3.4% as of last month, the lowest reading that we've seen in 50 years. And then for earnings this week, I'm going to be watching Lululemon. They're expected to report earnings Thursday after hours, where their earnings per share is expected to come in at $2.01 versus $4.40 as of last quarter. So that's about a 50% drop in earnings per share quarter over quarter. And then from a year ago, they were doing $1.48 earnings per share. So that would be about a 30% increase. And over the last 8 quarters, they've done an average of $2.24 earnings per share. For revenue, they're expected to do $1.92 billion versus $2.77 billion as of last quarter, $161 a year ago, and over the last 8 quarters, they've done an average of $1.8 billion in revenue. Retail earnings for this quarter has been pretty terrible, with Target going down by 13% after their earnings, Walmart going down by 2% after their earnings, and Ulta dropping 13% just the day after their earnings report. So retail earnings really aren't doing very well. All the money is just going into tech stocks right now. So Lulu, probably going to be the same story. But where's the stock going to go? Well, we have to look at our technical analysis. For SPY this week, we have supports at $418.21, $416, and $413.50, and resistance at $421.21, as well as $425.50. The expected range for SPY this week is $7 in either direction, or about 1.6%. Putting it between $413 and $427 by the end of this week. And then for Lulu and their earnings report, the expected move this week is $28 in either direction, or 8%, with their support levels at $335, $321.25, and $305, and resistance at $349, $359.64, and $368.44 by the end of this week. Right now, the relative strength is extremely weak at 28 for the RSI. So it's looking very bearish. MACD is crossing over for both lines. So just like all the other retail names, this one is a sinking ship. And my projections, if they end up beating their earnings per share, beating their revenue, their stock might go above $350. If they beat earnings and miss revenue, I expect their stock to stay above $335. If they miss earnings, beat revenue, I expect their stock to be above $320. And if they miss earnings and revenue for the quarter, I expect their stock to be sinking below $315 by the end of the week. So that is my earnings analysis for Lulu. Hopefully this video was helpful. If it was, show some love, leave a like. Thanks for making it to the end. And thank you to all my channel members and my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.